Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Space Equities and Valuation Analysis. This video presents a direct informational narration of the source document. We're looking at a comprehensive breakdown of the rapidly expanding space equities sector, all anchored by the massive shadow cast by SpaceX. We're going to systematically analyze the underlying data driving these valuations to really understand where the actual risks and opportunities lie. Here's our agenda. We're going to follow a structured, top-down institutional research flow. So we'll start at the macro level with a rigorous breakdown of the SpaceX valuation thesis. From there, we'll move to the micro level, mapping out the ecosystem of 7 publicly traded space equities, comparing their fundamental financial metrics and evaluating their 5-year growth projections. Finally, we'll categorize them into specific growth tiers and establish objective technical support levels for risk management. Section 1. SpaceX Valuation Breakdown. To build our baseline understanding, we've really got to first address SpaceX's staggering $1.75 trillion valuation and the underlying assumptions regarding its total addressable market, or TAM. Now, looking at the reality of the revenue ceilings, the prospectus data paints a long-term vision projecting a $28.5 trillion total addressable market over 10+ years. But that assumes a near 100% monopoly. If we look at the current ceilings, excluding the China and Russia markets, traditional space operations, things like launches, lunar transport, and mining, well, they're capped at around $370 billion. The connectivity segment, which includes broadband and direct-to-cell, maxes out around $1.6 trillion. Even if you combine them, these two primary space sectors total roughly $1.9 trillion. Meaning that current $1.75 trillion market valuation has practically priced in the absolute peak of these traditional markets. So this data breakdown illustrates the hidden valuation driver. Based on Goldman Sachs roadshow estimates, SpaceX is projected to reach $474 billion in total revenue by 2030. That represents a massive 91% 5-year compound annual growth rate. But take a close look at the breakdown. Starlink is projected at just $4 billion, and traditional space operations at $8.3 billion. The vast majority, a whopping $322 billion, is sourced directly from AI infrastructure and data centers. The crucial takeaway here is that SpaceX's future growth and its ability to justify further multiples are heavily reliant on AI execution, not just space or connectivity. Section 2. Space Competitor Overview. With that SpaceX baseline established, we can now map out the broader ecosystem of the 7 publicly traded space equities and see exactly what their specific market positioning looks like in relation to the industry giant. This matrix objectively delineates the business models for all 7 competitors. While ASTS focuses on direct-to-cell satellite connectivity, Lunar operates in lunar infrastructure and services, remaining highly reliant on NASA contracts. RKLB is a pure-play medium and small rocket launch provider, making it a direct competitor to SpaceX. Meanwhile, RDW provides in-orbit manufacturing and space infrastructure tied to steady government contracts. PL offers high-frequency Earth observation data. Looking at the more traditional models, SATSA operates in satellite broadband and notably holds a SpaceX equity. And VSAT provides mature satellite broadband for aviation and maritime. Importantly, nearly all of these companies, except for those direct launch competitors, act as collaborative partners, utilizing SpaceX's Falcon 9 for deployment. Section 3. Financial Metrics Comparison. Shifting over to the fundamentals, we'll now break down the current trailing 12-month, or TTM, financial data. We're going to rigorously review the exact current market capitalizations, revenues, price-to-sales ratios, and earnings per share. Starting on the high-growth side, ASTS commands a $27.9 billion market cap with $85 million in revenue, resulting in an extreme 328 times price-to-sales, alongside a negative $1.8 EPS. Lunar follows with a $4.7 billion cap and $334 million in revenue, trading at 14 times PS with a negative $0.87 EPS. RKLB holds a significant $63.7 billion market cap on $680 million in revenue, reflecting a 93 times PS and negative $0.33 EPS. RDW was positioned at a $3.6 billion cap and $371 million in revenue, sitting at 9.7 times PS with a negative 2.59 EPS. Examining the more mature operations, PL stands at an $11.4 billion cap with $336 million in revenue, a 33.9 times PS, and negative $0.8 EPS. Finally, the legacy providers SATS and VSAT show high revenues but compressed multiples. SATS holds a $3.37 billion cap on $1.48 billion in revenue at just 2.28 times PS with a negative $50.2 EPS, while VSAT rounds it out with a $9.1 billion cap on $4.64 billion in revenue, trading at 1.96 times PS with a negative $0.25 EPS. Section 4. 5-Year Growth Projections. Projecting forward to the 5-year horizon, we transition to institutional estimates for 2027. These forward-looking multipliers reveal a really stark contrast in compound annual growth rates. ASTS leads the pack with a massive 132% projected CAGR, followed by Lunar at 55%, RDW at 40%, and RKLB at 36%. Conversely, the legacy providers show almost entirely stagnant growth. PL projects at 25%, VSAT at a mere 1.5%, and SATS remains basically flat at 0.3%. Section 5. Growth Tier Classifications. Synthesizing this raw financial data allows us to build a structured risk and reward framework, classifying these equities based on their growth velocity. Tier 1 equities are defined by high growth and high risk, and this includes ASTS and Lunar. Now, these companies offer the highest potential upside because they target niche, high total addressable markets, direct-to-cell phones and lunar infrastructure respectively. However, they carry extreme execution and regulatory failure risks. We're talking about volatile, binary outcomes here. If they execute, the elasticity is massive, but if they face regulatory hurdles or technical failures, the downside is equally severe. Next up is Tier 2, representing steady growth and conservative risk. RKLB and RDW fit right here. RKLB is the most direct, pure-play competitor to SpaceX in the launch vehicle market, featuring solid fundamentals and a path to commercialization by 2028. RDW, on the other hand, offers steady, predictable growth heavily tied to government budgets and contracts for space infrastructure. Both offer slower but much more reliable growth trajectories compared to Tier 1. Then we have Tier 3, which includes the stagnant and slow growth equities, PL, SATS, and VSAT. As the data just showed us, these companies represent highly mature business models that have largely reached their market ceilings. They exhibit low multipliers and minimal to non-existent compound annual growth rates. From a high-growth risk portfolio perspective, these are fundamentally removed from consideration due to their lack of velocity. Section 6. Technical Support Levels. We'll conclude this fundamental analysis with an objective framework for technical downside risk management. Keep in mind, these figures serve solely as an objective risk reference for managing technical downside. Looking first at ASTS, it shows a strong support level around 20, with subsequent ultra-strong supports dropping down to the 13 and 12 range. Moving over to RKLB, we see strong support at 92, dropping to 74, and further down to 54. For RDW, support drops sequentially from 15 down to 12 and then 10. PL has support near the market price of 31.8, descending to 26.9 and 15.9. SATS has support right under the market price, with further structural support below 84 and deeply down at 3. Lastly, VSAT has its strongest support levels clustered sequentially below 51.2, dropping down to 29. To wrap up, we want to leave you with this final, data-driven question to consider based on the source text. Will that massive $322 billion AI infrastructure revenue actually materialize to justify SpaceX's trillion-dollar valuation? And ultimately, which fundamental tier of these publicly traded space equities will actually survive the coming industry consolidation?